We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Trader Ferg, full-time trader and author of the Trader Ferg Substack. Ferg, thanks for joining me today.
Thanks for having me on, Tom. I've been a big fan of the show for a while, so it's a real honor to be here.
You know, it is kind of funny when I heard you say that today when we started recording, or when we started speaking. I kind of forget that, you know, when I have my head down in the laptop, that my voice does get out to people like yourself that take these subjects so seriously and write about it so diligently as you do. You know, going through your Substack, I really enjoy your style of writing because it's well illustrated with charts. And I think that the idea of kind of stepping back and always taking perspective is really important. That's something I really search for often, or, you know, the most valuable part of some of the interviews I do is being able to sit back and take a longer term perspective on this. And I think that is really illustrated well by something you've written about in a roundabout way several times. And that's this idea of always being on the lookout for when a major narrative pivots. So what is an example of that, do you think?
Yeah, so it's something I'm always on the lookout for is, yeah, as you say, like we're a whole lot of people betting on a certain future that I think is not going to may not play out, or the valuations don't justify it. And so I see kind of, if you break it down into maybe two or three, I guess you can break it down to the moment, is I've written about the pivot from EVs to plug-in hybrids. That's a big one I've seen. And that's kind of tied into the bigger sort of pivot I see happening at the moment is just the broad acceptance that net zero is not going to happen, and that a lot of the projections we've seen are just not going to become reality. And I've been talking about this for a few years now, but I think now we're really starting to see some data points that are kind of backing this up and can go all down these rabbit holes, whether it's the likes of BYD with plug-in hybrids really scaling up, and their EV operation kind of not being essentially in a standstill, whether it's the likes of China, which has actually been driving a lot of the wind and solar adoption there. If you watch closely what they've been doing, in April 2024, they've stopped giving wind and solar energy producers prices match the coal index, which is kind of a big deal because that really shored up the pricing they'd receive. And now that they don't receive that, if they have like a circumstance similar to what we've seen in like California, Australia, where you have prices get pushed negative, then that really puts the brakes on. And so I think a lot of the projections we've seen for China's adoption of those of both wind and solar will prove to be far too optimistic. Mm-hmm. And you also got, with that, tying back to the EV versus hybrids, you've got the sort of the layer on top of that was the assumption that lithium would be the ultimate winner in batteries. And I think that's proving to be incorrect, as the first kind of assumption was that they would all be BEVs, like battery electric vehicles, which require a huge battery. And then once you shift to a plug-in hybrid, you've only got 1/3 of the battery. And then got the fact that a lot of the plug-in hybrids are also focusing on sodium-ion, which can potentially do away with the need for lithium altogether. And so I just go around the world looking for these kind of like certainties, and think like, what's the other side of this that is being underinvested in and will really benefit when this certainty is shown to be false. And so like examples of that could be whereas the certainty is the lithium was going to be the ultimate winner. I think a big winner from the pivot back is PGMs with solar and wind. It was the idea that that would make up a big chunk of the energy mix. I think that's incorrect. And I think coal's going to be around a lot longer. So all the underinvestment in coal, it's a pivot back to that. And so all things even, yeah, you get really good outperformance. But yeah, I can go down any of those rabbit holes if you want.
Well, I mean, going back to this idea of really kind of illustrating these examples with charts, and even when you and I spoke a little bit before we hit record here today about the idea of coal making a resurgence, despite Germany wanting to go green, trying to, transition their grid to being a very renewable based grid. And then the unfortunate situation of the Ukraine war and the pipeline that got bombed, or, whatever happened to it. They burnt more coal last year than ever before, right? And, the other example of the lithium batteries versus the sodium-based batteries that BYD out of China is coming up with, that adoption curve to me looks extremely impressive. And, I think it is very instructive to look at that chart and to try to understand how quickly those Chinese EVs are growing in the world and the adoption of those versus these Western auto manufacturers from the EU or the US, right?
Yeah, that's why I spend so much time on BYD. And people often say, well, like, why are you concentrating on one car company? Mm-hmm. And the way I think I borrowed this from Lewis Vincent Garth, but it was just, you've got to understand that since China's property bubble sort of rolled over, they've really focused on industry, and they've just been running essentially the Hunger Games in each industrial sector, and they've just given them as much access to as much money as they require, and then they've just said, like, go out and be competitive. They started off with subsidies, which was buying by a lot of the state-owned entities, would have orders, and then they've been phasing that out so that they kind of stand on their own feet. So it's like the Hunger Games is the winner, and the one that pops out is just massively competitive on a global scale. And the winner of the Hunger Games, for me, looks pretty clear that it's now BYD. And this has got big implications when you see the gap that's opened up between like global EV manufacturers and BYD. Like an example is like you look at the Seal, it can do 2,100 kilometers on a single charge in a tank of gas. And if you take that one step further, if they install a sodium-ion battery in that, so that they've broke ground, started last year, they're put 1.4 billion into a sodium-ion factory that should have the capacity to produce all their plug-in hybrids with sodium ion, and that these cars are getting currently priced at 14,000 US, and they're vastly superior to everything in the West. And so this I've kind of compare it to, like, we used to wait around for the next model of the like iPhone to come out, and there'd be like some like massive leap, like have GPS, or like there would just be an epic innovation. Like all the innovations happening in China, their latest four-wheel drive can like float, and it can turn on the spot. It can parallel park pure sideways. And yeah, it's a lot of people say, oh, what does that matter? Because they're just going to get tariffed. They won't have access to the US and the EU market. But that's not where all the demand is. If you actually break down where all the strong demand is, it's the rest of the world, so the full developing world. And when you price vehicles this cheap, that's going to be they're going to be the ultimate winner. And lastly, to overlay one more sort of observation with this, is if you see a sort of a structurally higher inflation future like I do, then the fact that you've moved away from very sort of energy intensive materials to mine to very cheap Like sodium ion has none of the sort of the critical metals. You remove nickel, you remove cobalt, you remove lithium.
Mhm.
You're largely focusing on was it names escaping me? Soda ash, and the Chinese. I thought it was all mine, but the Chinese can largely make it via a synthetic process with coal, and so you've completely turned the game on its head, and a whole lot of assumptions we've made in the West on on everything from all these mining supply chains get turned upside down. So yeah, this is the stuff I just want to spot it early and try and get on the trend that'll benefit. Yeah.
Mhm. Well, I think one more point to kind of, let's say, illuminate before we move on from that is this idea of these tariffs on, let's say particularly BYD or Chinese EVs or, plug-in hybrid electrics, as it were, because, instead of taking the emissions reduction and continuing to, let's say, flounder with these lower range, higher cost EVs that we have in, out of the EU and out of the US. Instead, we're taking the hit and imposing tariffs on what is, by all rights, far better product.
Yeah. Well, I think we talked before we started recording about I think Lewis Scarve put it the best. He said, "Oh, at least the climate emergency's over."
Mm-hmm.
If it was such a existential emergency that we need to do everything in our power, like why are we throwing tariffs on the best technology to reduce emissions? Like why are we now tariffing this technology into the ground? Which means they never really believed in it. It's if you're gonna, the EU and the US, which were the main proponents of it, just tariff them into the ground, the best technology, then it's not what they really believe in. So I kind of thought that was a very valid point as well. And the main point is just I think when you boil a lot of this stuff down, it's just like if these products were put in front of you, what would you choose? Like I know I bought a car like 2 years ago, and my selection was like what could do, say, 500 Ks, and I think I paid 30-40 grand for it. And if I'd had the option of a seal that could do that, so like I'd only need to fill the thing up twice a year, maybe not even that, because a lot of it's me going to pick up my son in the rain or something from his play group, and I'd be able to do it on the battery, so I might not even fill it up. That's an absolute game changer. I wouldn't have to line up at the petrol station every 2-3 weeks. I wouldn't, like, when it's just that obvious that it would have been literally less than half of what I paid for my new Toyota SUV, whatever it is, and it's just a complete game changer. And I think there's going to be a lot of unexpected demand because a lot of people can now afford these. Like it's really brought that what was originally the promise of EVs being this absolutely breakthrough technology and beating internal combustion engines on sort of price. We're actually seeing that with what China's putting out, and there's going to be that's going to have a real effect for adoption in the developing world. And they also overcome the fact of, like, where I live here in Bali, the power is just not stable enough to like the grid's not going to be able to handle like fast chargers and stuff. And I've even got some friends that had electric scooters, and they got too frustrated and gave up, because it takes to charge a sort of a scooter with a standard wall socket takes like at least a full night, if not a bit longer, to get to full charge. And it's just inconvenient. Yeah, it just doesn't work. Most people don't have their own parking to charge. They park out in the street or somewhere. And so with a hybrid, it just gives you the best of both worlds, gives you the efficiency, and it wins on cost. So why won't that be the massive adoption moving out?
I think another interesting parallel to these major narrative assumptions, in a way, and thinking about these secondary and tertiary effects of this, is this new release of the DeepSeek AI versus, let's say, ChatGPT and Grok. Fill us in a little bit on your thinking. This is obviously very, very fresh, very new. We're recording this on what would be Sunday night, the 26th in the US. And this seems to be, a very big development. I think last time I checked here, NASDAQ pre-market futures are down over 200 points already. This could be a real game changer. So how do you frame this other assumption of having, all of these new industries pivot towards this massive AI adoption that is super energy intensive?
Yeah, so I just wrote a piece. It was just for my Ferg's Finds, but I just found this fascinating because this was like the release of like a silver 200K range and none of the critical metals pretty much, and a price tag of 14,000 was the kind of the death of the EV, the costly EV. DeepSeek, that's like, just to run through it so people understand, like DeepSeek is on par, if not outperforming ChatGPT, the latest version, on the majority of metrics. You can go to, I think it's Analyst, and it will go through all the different models that use, and you can see that it's I think on the 6 main segments they use, it's outperforming it on 3, and it's on par with the other 3. And this is mind-blowing, considering this thing is the input cost of this is less than 1/10 of ChatGPT 4. And it also doesn't require the data centers, as this is essentially stacked personal electronic devices. Like, this is like linking a whole lot of laptops and desktops together. And the fact that it's outperforming ChatGPT 4, like, and it's open source, so you can't really point the finger too heavily at China. You can download this if you want. It's makes the whole AI kind of push quite sustainable, as it's a fraction of the power requirement. And so instantly the question is, like, first question, like, why would I pay $20 and $200 to ChatGPT if I can have DeepSeek, which performs better for free? The next question following that is, why are all the companies, how much is their valuation being inflated based on their AI investment? Like, you can look to date, there's been over 100 billion invested, and you only have to look around with something like I think it's the Stargate project. Sam Altman sort of throwing around another 500 billion required for that. I think people are starting to ask that question, and I don't think they're going to like the answer, especially if you look at something. Sorry, you managed to get back in. Especially if you look at something like NVIDIA with a price to sales of 30 times, it's EBITDA. The average analyst is predicting that it's going to grow 140% this year, and it's going to grow another 50% next year, and it's going to grow nearly 30% the year after. You need to start questioning this with what you're seeing with DeepSeek, and I think people are starting to question that now, and it's fascinating because this is kind of like .com type a scenario where, like, I also see a very inflationary future. We can go through the whole US position, but the last place you want to be is someone that's overinvested heavily in capex. Like, all the like the Mag 7 companies are beautiful business models, maybe minus the likes of Tesla, but the real software heavy companies like Microsoft and Facebook, Google, they're like a beautiful business, but they were a capital light business, and suddenly they've all gone super capex heavy, and the market's given them a really high valuation, expecting this kind of all this capex investment to provide a return, and they're just going to have to slowly put up their hand and say, yeah, it's probably largely a write-off. and I just, I find it really fascinating. I think this is super fascinating time, as there's also the fact that investors didn't largely drive these valuations to where they were. It was largely passive flows as well. And I've kind of observed it a few times, like who buys like Nvidia off passive when it needs to rebalance to maybe something index needs to rebalance. Like who's there to take it off its hands? Like active has now shrunk to less than a third, and they've had such a hard time. They'll be all over what's working, what the passive needs to rebalance into. And so, yeah, I think you could see some air pockets. But I've been wrong about this for a while. But I think DeepSeek is kind of going to have a lot of people ask some pretty serious questions at the moment with these valuations.
Mm-hmm. Yeah, it's going to be really interesting to see how this plays out. And again, that's just a perfect example of how these narratives can just get turned on their head instantly based on a lot of these assumptions and projections. But I want to go back to the other part of really thinking this through. You know, it's not just the valuations, let's say, of that particular company that we're only worried about. You know, they've signed energy contracts. Microsoft has, for example, reinstated no affiliation the Palisades nuclear power plant, and they've bought all of the power that's going to be coming from that. Like, thinking about those secondary and tertiary effects, if DeepSeek is this, you know, massive game changer that is so much more efficient, you know, power wise, that completely changes that dynamic of this, you know, part of this nuclear renaissance that we've also seen, does it not?
Yeah, 100%. You need to back out a lot of those demand assumptions. That's what I've always kind of observed. Like, I want the most robust demand assumptions if I'm going into a commodity. I don't want I put a lot of them like fantasy assumptions. Like, right from the start, I never saw all the demand turning up for lithium, that all the money was being invested on. And even say copper. So copper was S&P Global. They saw half of copper demand out to 2035 being on the back of wind and solar and EV demand. And it's, again, like I love the copper bull story, but you're going to have a rough time if half the projected demand sort of disappears, and there's been a lot of capex sunk on that expectation. And so I've always tried to hang out in sectors where the demand is either non-existent, like thermal coal. Like, by buying a thermal coal company that's trading at sort of 3 times cash flow, they're saying that it's terminal values in 3 years, and that it's not going to be needed after that because we'll be living off solar and wind. And so I'll happily take that bet every day of the week, and that's largely been working out pretty well. And the where I was trying to get back to with that was with nuclear as well. So I've kind of backed out every demand increase with all the sort of AI increase. Like, the nuclear story was always just on the fact that with what's operating and what's under construction, there isn't enough supply. So I never added on any of the AI sort of hype. Just with what's there isn't enough to go around, and there needs to just the utilities in terms of what they need to replace. Like, it's you can go through it. The term contracting, it's about 180, call it maybe 190 million pounds a year. 2023 they contracted 150, 160, and last year, surprisingly, I thought they would contract at least replacement. They only contracted 105, and so that's where I see, well, why I'm still so bullish uranium is that it needs to hit at least replacement, and historically it shoots through. They will maybe hit a high of sort of 130, 140% of replacement. And that's where I like to hang out, is where there's no fluff in the demand model. And another good example is PGMs, the likes of palladium, platinum, and rhodium, is the fact that with EVs being projected to have such a massive adoption curve, there was going to be no need for catalytic converters. And so no one wants to put much money towards growing PGM production when obviously you've seen the demand rollover. And so I think that sets up for all things equal, it sets up for really great future for pricing for them when there's been underinvested on the supply side, and the demand side keeps getting stronger, which is where I always come back to keeping an eye on the likes of BYD's production and sales reports that it releases every month, and you can just see them. Like the last one they released in December, their plug-in hybrids are up 80% year on year, whereas EVs are scratching 10, and yeah, that adds to demand that's just going to keep showing up, that no one's kind of projecting.
Yeah, I think this case that you lay out in one of your pieces about the ongoing demand for platinum, X these very, let's say, unpredictable demand curves of pure EVs, when something like that could change so much over the next, let's say, 5 years, especially when these companies like Ford, for example, are not making money on their EVs, and they are stopping development on some of them, as I think the last report that I saw was. These things are, I think, great places, as you say, to kind of hang out because of this demand curve. But what is the other side of this idea of, let's say, the PGMs, especially, let's say, platinum? What is the other side, the supply side? How does that factor into your thinking around that thesis as well?
Yeah, so obviously supply is the most important because it's the hardest. I think there's this report that was written a while ago by Marathon Resources, and they have this one page that said always focus on supply, because supply is like kind of hard fact, whereas demand's always kind of a moving target. It's always hard to know where demand will actually land, whereas supply, if it's underinvested, then that's very hard to change. It takes a long time. And so with PGMs, or platinum in particular, how geographically focused it is. So it's essentially all in South Africa, and it's all the prolific stuff is just in Bushveld, which is pretty much like a reef that goes around the bottom coast of kind of South Africa, and that's where all the highest grade deposits are. And that's when you bring up a chart of the sort of the decline, it really starts rolling over from 2030. And this has got like big implications because no one's got any plans to bring new supply on. If anything, you've seen a lot of these companies put stuff into care and maintenance, which is kind of almost a similar parallel to what we saw in uranium, where companies go under their cost curve, like the likes of Sibanye. A lot of their production is in the 1,100, and with platinum and palladium being slightly under 1,000, then they have to shut in some mines, as they've done with some of their US operations. And it's just the cyclical commodity game over and over again. Is price gets too low, production gets curtailed, price spikes, more production has to be brought on. There's a lag, but price overshoots. Too much production gets too much supply gets brought on eventually, and the whole thing rolls over. And so with PGMs, what makes it so interesting is when you look around, you see that the main supply that will be brought on in the next 10 years is in Russia. So that's via Nor Nickel. So they produce, it's largely a nickel deposit, but they have a byproduct that produces mainly palladium heavy, with quite low levels of platinum and very low levels of rhodium. And they had a decent sized capex project, but that's been pushed out 2 years. So that's not going to be the savior. You've got Zimbabwe, which they also are planning to grow, but it's pretty marginal versus just the sheer size of South Africa's production. And so it really is a South African game. And as I said, they're not investing. All their mines are higher cost, and you layer a whole lot of sort of geopolitical risk. Like anyone that's been monitoring there, they've been having a lot of load shedding, which there's estimates that that's reduced their outputs somewhere between 10-15% globally. You've had sort of a lot of the uncertainty over elections, like it's been shored up a bit with the Democratic Alliance. Now being sort of minority party, but for a while there, they were thinking maybe it was the sort of economic freedom fighters, or so some of the other parties were talking about full nationalisation. So that's not very, companies are going to be pouring money in. And also it's just this whole push that we're seeing out of the mining majors, that they want essentially all the commodities that are part of the transition off their books. So you're seeing the likes of Anglo American that's offloaded its thermal coal assets a while ago in Whangela. That was an interesting little case study, because within a year that was a 10-bagger, and Anglo share price had largely gone nowhere. And now they've said by halfway through this year they're going to offload Anglo American Platinum. So they were originally, I think they owned 75% of it. They're down to about 67, and they've now said they're going to do an IPO by sort of mid-year to offload that. So it'll be interesting how that's received by the market. But yeah, a lot of my strategy has been going around picking up everything that these majors are offloading in terms of coal. Mainly coal, mainly the likes of like Whitehaven and Peabody, and a lot of them have been picking up these assets that have been spun out for non-economic reasons. The reasons they're doing this was largely to try and get a higher multiple, because they were focused on essentially ESG related commodities, the likes of copper and lithium and other transition metals.
So Ferg, does this, this kind of framework about thinking about a particular sector that has been underinvested in, does this also extend to, let's say, the oil and gas sector in the US? And does Trump coming in with the narrative of drill baby drill really change the way that this, the outlook for oil and gas looks in the US?
For me, not really. So I wrote probably one of the longer pieces I've written recently, because I wanted to do this whole topic justice. And I think when you look at all the main variables that everyone's sort of, because for starters, like oil bearishness got to kind of a peak. Like I haven't seen everyone get just flat out almost hate it at the end of last year. A lot of it was to do with tax loss selling. And when you dig into that, there's a few factors. One was weak demand globally, and people projecting for that. That's already, like the IEA and the EIA already kind of revised up their numbers. I largely agree with them now. The demand side's going to not be crazy strong, but it's going to be decent moving forward. So then you move on to supply, and I see the supply numbers just being completely wrong moving forward. I think the idea that shale is going to continue sort of its growth trajectory has already been proved wrong. It's largely stalled out, and if you actually dig beneath the surface, you're seeing that a lot of the reserve reports, the crude is actually rolling over, and they're just getting gassier, and NGLs are rising. And this coming to what Trump's saying, sort of this drill baby drill 2.0. You just have to read what the companies are saying, and that they've realized that they are down to the last of the tier one assets, and if they increase drilling, their assets going to get they'll work through them quicker, and they'll be on to inferior stuff, and so they'll destroy their own sort of reserve bases. So they've had to really slow down, and you can see this if you look at like Chevron's announcement. I think Exxon's probably going to be making similar announcements once. You can just look at what Pioneers that it's just acquired its reserves are doing, and this all goes against Trump's sort of the idea that he can get some regulations out the way. But I think when you really step back to shale, there's a beautiful analogy going back to the 1960s, 70s, and 80s with oil, in that as you work through the last of the tier one, your productivity goes through the roof. And that's what there's been lots of sort of clapping and fist pumping about how high productivity's got. But that's that's to be expected when you're reducing the rig count. So you're going to take your least productive rigs off as the rig count is reduced, and productivity keeps going higher. The real tell will be if oil rips, and as you start adding back to the rig count, what does productivity do? And historically, they've mirrored each other. So if the rig count starts rising, productivity will fall through the floor, and that's because you're on to see tier 2 acreage, and that's what I kind of that's where I believe we are in this whole cycle. And this is playing out. If you look at real-time data with what shale's putting out, is it's largely stalled out the last sort of year and a half, if you back out the sort of IEA and EIA's adjustments. And this is, just goes hard against the narrative that Trump's pushing. And if anything, what Trump's talking about as well will be, he's talking about refilling the SPR. And that, if you put that on a 2-year time frame, that adds about 400 barrels a day to demand, which is pretty significant. If he does it over 4 years, it's like 200, which is a bit less, but that's pretty bullish in itself. And if he does get what he wants in terms of lowering oil prices here, a lot of the US shale producers, they're anything around 50, they'll really have to cut back capex, because they'll be pushing close to their sort of break evens. And I think people just are overestimating what he can do, whereas you just read all the what the oil companies themselves are telling you, and I don't see it happening. So I'm all over a whole lot of oil plays at the moment. I think it's probably one of the best risk rewards the market's giving you.
So that being considered, and the price, that basically the price of energy that's tied to everything, Ferg, when we consider that, I want to tie that into something that you had mentioned earlier, and this idea of really moving into this inflationary future, especially for the US. What are, does that energy price really tie into that as well? Or is this more so just based around basically more printing of the US dollar to satisfy all these requirements of getting all these things done? And, Trump, at the end of the day, needing a lower value US dollar to increase demand in the rest of the world. Like it ends up suiting every aim that he has outlined.
Well, that's I always just joke, all roads lead to inflation, because there's literally no other alternative. Like, you can't, if you look at ways that you can actually fix the current sort of budget problem, it's really only austerity, default, or sort of inflated away. And when you go through the sort of austerity exercise, you pretty much everything that would really move the needles off limits. Like, I think, was it 87% of outlays are non-discretionary. Like, are you going to touch defence? Are you going to touch entitlements? Maybe they can cut a little bit out of Medicare with efficiencies like this Doge. I just don't see how the whole government efficiency, what did they promise? 2 trillion. Like, I think non-discretionary is 1.7 trillion. They're just going to chop out the entire non-discretionary spend. It's like, once you run the numbers, you just quickly realize this doesn't really add up, and the way out of this is to print the difference, and there's no way around it. And so once you come to that sort of idea that's going to be structurally higher inflation, then the game really is real assets, cash flow. You've seen this in the past. Like, this is why I go back to the 70s, and why I like coal so much is a lot of people don't realize, like, coal is the best performing asset in every sort of inflationary cycle, and that's just because it usually starts from such a low valuation. And you've also got this kind of dynamic where, if you're in a period preceding inflation where you essentially have companies that, since there's no expectation of inflation, like what will you go into? You go into like a sort of like a non-profitable tech company, or something where where the profitability is pushed right out into the future. Well, you can't have that when inflation rears its head. You've got to have something that's beating inflation with cash flows on a yearly basis, and that's why I like kind of hanging out all this real assets. So like I wrote this piece called Moats and Cannibals, and I was just trying to work out what, if in a structurally higher inflation environment, what would have the biggest moat, and the cannibal side of it was they could just buy back their shares because the moat would be so high. So I kind of identified a whole lot of stuff that had gone bankrupt, like offshore rigs where they've written off billions and still have the rigs, and there's no ability to build the rigs for a number of years. You've got likes of miners that went bankrupt, and maybe some of their acquisitions were completely written down, and they've shown a willingness to buy back stock, even if the market won't give them a higher multiple. And yeah, that's kind of the world I see coming, because I don't see any alternative. I don't see, if you look at the income side, it's a lot of the tax receipts are like pushing sort of all-time highs as well, with how juicy economy's been, and I don't see how Trump can put a lot of his sort of policies in without impacting that. I don't see how the tariffs could provide a big sort of income source without really nosediving growth, and also a lot of the companies that are holding up the S&P, I think, was it 60% of their earnings are overseas as well. So surely there'll be retaliation by companies, by the countries that you're putting tariffs on. So yeah, I'm not particularly good on the whole macro. I like just to dig right into the industries and have like figures I can hang on. But my overall view is every time I go through it all, I just don't see any other outcome than inflation on a longer term time frame.
Mm-hmm. Well, I think directly in that vein, and this ties in this idea of questioning these longstanding narratives and these, particular correlations that have stood for, let's say, 40 years is the time frame, let's say, of the next one that I wanted to bring up. And that's this idea of gold treasuries and real rates. You wrote a piece on this as well in the last year. Why do you think that this correlation has changed so much? And what is that correlation that most people have traditionally leaned on?
Yeah, so that's fascinating, because that's as you say, everyone has got super used to it. I guess like the clear examples, it was like the 60-40 portfolio. Like you can always rely on bonds to sort of rally and hedge your stocks, and that's largely been true for decades now, with rates falling, and it was a beautiful trade. But now with where we've arrived in that correlation breaking down. So I think where I went in that piece is gold's going to kind of play a very interesting role moving forward, with the US kind of having overused their sort of weaponization of the dollar, is that gold's going to be used to sort of net settle a lot of trade in the developing countries. Mm-hmm. And on the back of that, it's going to sort of play a different role than it has, because for a long time I refused to sort of touch gold. More recently, that's been a mistake with how it's performed, because I kind of saw it as a political metal. Like I saw it as when the paper gold market could always be expanded, so you never had real price discovery. I was like, why do I want to be sort of partake in this? But now I see, especially when on the back of it was already happening for a while. It's been happening since sort of 2008, when I think a lot of countries decided it wasn't smart to hold so many treasuries. But really, since Russia had its sort of US assets confiscated, a lot of countries are like, oh, we need a different system. We need to be able to sort of bypass this and trade between ourselves. And you're seeing far more contracts be priced in their own countries and net settled in gold. And this is a game changer as well, because going like full circle back to what we're talking about with these Chinese industries, not just EVs, but a lot of, like, whether it's 5G, whether it's electronics, they're producing their own chips, is when these countries can trade between each other and net settle in gold, then you remove the bottleneck of the US dollar as well. And so you could really see trade explode on the back of that. And that's something that makes me very bullish, just emerging countries in general, which has been, obviously anyone that looks at the chart's been a dog of a trade. It's that whole sort of rear vision mirror investing. You've had a really rough time unless you've been in just the US, and in particular the Mag 7. And so I see this again as a sort of a reason why the US is probably in for a really rough decade moving forward, and a lot of the developing countries are really going to surprise the upside because they've had this bottleneck of USD removed, and they'll be able to get access to a lot more of the sort of commodities and energy they require, and a lot of the goods and services out of China, which will be very cost competitive. Don't know if I went off topic there a bit.
Well, again, I think it just ties back to this inflationary curve for gold and what that real return ends up looking like for treasuries at the end of the day, right?
Yeah.
Obviously, that changed dramatically in 2022 with the US seizing Russia's assets. And as you said in your piece, like this time in history is going to be written about very, very poignantly. Mm-hmm. And I think one of the other important points was this idea that you brought up of what the total holdings of ETFs have done despite gold price continuing upward, right?
Yeah. Well, that's been interesting in itself. Is the fact that like gold miners haven't moved, and for that period, when I wrote that piece, it's died down a bit since that. But for that period, you were just seeing a lot of purchasing of physical. It's like that cartoon I always joke about. That's there's just this fence in the middle of the cartoon, and it's the West all throwing their gold bars over and China throwing money back. And there was just a premium in the Shanghai exchange, and they were just essentially hoovering up all the physical. And it's a way for them to essentially, he's on again. He touches the keyboard. It's a way for them to get control of largely the physical market, which again, going back to it being a political medal, that was never allowed to happen. Like there was always if someone just bought a whole lot of gold futures and demanded physical delivery, you could have really stuffed up the gold market. But since that never happened, kind of told you, there was bigger forces at play there. But with the ETFs, essentially when you looked at the ETFs, it was telling you that retail wasn't participating; it was something else, because the gold holdings were falling. I still, what I struggle with this is I still haven't found a great way to play gold. Like as I sort of talk about gold being revalued, I think I might just end up sort of having to own some ETF with a whole lot of small gold miners, because I can't bring myself to buy like junior gold. I've got enough miners in my portfolio that give me heartache. But yeah, so it's a hard sector to play well. That's what I always struggle with it.
Well, that's what I wanted to ask you about next is, considering your broad, really research area, from coal to PGMs, gold, whatever it is, you have a very, broad interest. So is there a certain way, kind of like what you mentioned, buying particular companies that aren't necessarily, let's say, explorers or juniors, as you said that in your piece that you wrote, you said that falls into your too hard bucket. So is there a particular, let's say, way you look at investing in, a handful of companies that is somewhat the same over these different industries and commodities?
Yeah, so there is, in that I'm trying to find a clean way to express a view without getting too stuffed up with going into bad industries. So essentially, these are all really shitty businesses, cyclical. Like you go bankrupt, lose money, miners will dilute you and give you nasty surprises all day long. That piece I wrote on the new energy pivot, that was me finding that angle of going with sort of a physical rhodium fund. That came about from just seeing, like, do you really, even though I really like the thesis, do I really want to have heavy positions to miners in South Africa? Like, that's just, you just got so much risk, and with a physical position, you are actually benefiting from that risk. Like, if anything, I think it's free producers between Sibanye, Amplats, and Impala. They produce, I think it's like 85% of global rhodium. And so if anything were to happen to those, you actually massively benefit from owning the physical. And so that's been something I'm trying to get better at, is find better ways to express it than miners, because, as I said, I just have so much heartache with miners. Like, you can love the numbers and you still just get absolutely slaughtered on geopolitical risk. A good example, that's Global Atomic. You can run around showing how good the project is all day. You don't have much to show for it now. And also something I'm enjoying more recently is trying to really break down the correlation. A lot of this was from taking absolute beating last year with stuff like uranium and offshore services. Like, they all went down heavily together, and so it's like, where's a beautiful setup that's a bit less correlated? And something I've become really attracted to recently is like Chinese tech, which just comes back to that sort of deep seekers. Like, there's almost no correlation between commodities and Chinese tech, and yet I kind of love the outlook for that. It's super hated. It's which is kind of fascinating, because if you're like an alien and you came down and you didn't know anything about valuations, you'd say the US and the Chinese tech were on reasonably even footing, until you were showing the valuations. You'd be like, how does that make sense? Especially now with the deep seek reveal. So I really like that. I am a big fan of restructured companies. So, as I think I mentioned before, there's something beautiful about a company that's very asset intensive, and that has to use a lot of debt to acquire all its assets. Like a clean example would be the likes of kind of a Seadrill, a Valaris, a Noble, in which they bought a whole lot of drill ships, jackups, semi-submersibles, and all went bankrupt. Wrote off all the debt, which is in the sort of range of 20 billion, and now demand's slowly returning to that sector, a lot slower than I thought it would. But competitors are going to have to compete with them when they're going to have all these rigs with no debt servicing cost, and competitors will have no ability to build the rigs on a timely basis, because the shipping sector that built the rigs has all gone bankrupt as well. And so the sort of timeframes are going to be more likely 5 years to build a new drill ship, and the money you'd have to put down, it's gone from 10% deposit to a 40% deposit, and the day rates to make the IRR work is probably north of 800,000 day rates, and we're currently sitting down sort of 400 or 500. And so when you put all that together, it's a really attractive business, and I don't have to get involved in miners, and I just have a really fat margin of safety as well. If a lot of things go wrong, they no longer have that debt load that gets you into trouble.
Yeah, I think, buying something cheap enough de-risks it to a certain extent. Obviously, there's always unforeseen factors that can come through, but I like this idea that seems to kind of flow through those different areas that we spoke about, which is, buying maybe restructured companies that are almost falling off the right-hand side of the Lassonde curve, that is just, kind of hated by the industry. If you see this demand picture coming, being patient and understanding that, again, buying something cheap enough that has this underlying value seems to be working up.
Yeah, well, it's also understanding decline curves as well. Like that was a big part of my oil piece, was historically sort of declines in supply have been sitting around 4 or 5% per annum, and that's quite manageable. Like you can keep up with that over time. Exxon's most recent piece, they have seen annual declines been up around 15% now, which is a really serious number. Like if there's no investment, then you're going to wipe off 15 million barrels per day in a single year, which is just shows the sort of enormity of what shale, like backing up just how much shale brought on. Like we essentially found like 2 Saudi Arabias with US shale, one in oil and one in gas, and that's overcame what was globally, like that shale provided over 90% of all the additional oil over that period. And before that, all the conventional was starting to roll over, which was a big issue. So we got saved by this. But now on the back end of that, this does roll over quickly, and that presents kind of a big issue because a lot of the lower cost barrels now is offshore, and that takes a while to come on. As I said, the industry has been a massive consolidation, so there's sort of less than half of the rigs that there was previously, and yeah, that's why I like hanging out there. I just see there hasn't been much focus on the decline rates because we're so used to the ability to bring barrels on quickly. With it's similar with uranium as well. So you've obviously got fracking with oil and gas, and with uranium you've had ISR, which you just bring on mass amounts of uranium quickly with Kazatomprom, but that's two-edged sword in that if you look at Kazatoprom's decline rates out to 2030 on, it really rolls over heavily, and that's a lot of additional uranium that needs to be found very quickly.
Yeah, again, I think that point needs to be underscored about what you said about supply. You can have all these fancy projections about demand, but supply ends up being where the rubber really hits the road, I think.
Yeah, it's mining's a hard business. Yeah, every time I even think I've got my thumb on it, I usually get punched in the face again. Like there's always a negative surprise, cost overrun. Because that's the other thing with a lot of this stuff is a lot of talking of whether a barrel is cheap or not. If you're talking in nominal terms, like we've had 25% inflation since 2020. People forget that. Like if you were talking $1 billion capex in 2020 and you haven't updated your presentation, that's now got to be 1,250,000 as of 2025. Like it's just, it creeps up on you, and people keep. I feel like that's something that's going to have to be adjusted as well, is like the realization that real matters again. And in the past decades, you've got away with kind of conflating real and nominal when it hasn't mattered. It's kind of like it's a parallel I've observed with the likes of capacity and generation. For a long time there, you could intermingle like capacity and generation, and it didn't matter because you were bringing quite standardized capacity on. If you were bringing gas, coal, nuclear, you had a very standardized capacity factor that was pretty well known. But as soon as you started adding renewables to the mix, it kind of threw a wrench in, because suddenly you had massive capacity and very little generation, and that little generation was not reliable either. It was all over the place. And so, yeah, I feel like it's probably what happens at the end of every paradigm, is all very used to what's been the past decades, and yeah, it doesn't do you much good moving forward.
Well, Ferg, I think that's a good place to kind of wrap up. I appreciate being able to kind of sew all of these different areas of interest together with the same thread. It was interesting to read these pieces and to go back and kind of consider this main thesis that you see these things playing out with. Is there anything that you'd like to leave our audience to think about before we wrap up?
Not really, other than knowing that this game's hard. It always has been. Like I feel the last 6 months has been really hard, because if you've been concentrated on a lot of the stuff out a few years, you've been really beaten up, and the stuff that was working just kept working even more. So often you have your face rubbed in it by the market just before something's really about to start working. I used an example in my recent oil piece when the height of the dot-com boom, Julian Robertson threw in the towel and closed his fund, and it was literally almost to the day on the top of the dot-com boom when he closed his value fund. And from there, it would have been his best performing years moving forward. And it's just like the market's got a way of kind of making you throw in the towel exactly when you shouldn't. And I find that fascinating, that particularly now with this DeepSeek, like there really is a question, like all these billions invested, like on what certainty moving forward. Like, and I feel like with a lot of the commodity space, we're very aware of that, the fact that these decline rates will matter. The world's not going to stop using energy. The world's not going to stop needing catalytic converters. The world's not going to, like, you can see this all in real-time data. Like the brilliant one is the likes of coal. Every year it's supposed to roll over according to the IEA. And every year it makes a new high. So that would be the point I'd leave on, is that, this game's hard, but if you can position where it's pretty obvious there's still going to be demand in 5 years and the market's pricing it like that won't need it, then you should do pretty well.
Excellent. Well, for anybody that wants to read more of Ferg's work, I base all of my questions and research on all my guests' work. All of his is available at traderferg.substack.com, and excellent Twitter follow as well at trader_Ferg. Ferg, thanks so much for your time today. Really appreciate it.
Thank you for having me on, Tom. Really enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.